The boroughs are New York City. The burbs are everywhere else. Real estate is the ultimate game of risk and reward. It's the biggest investment most people ever make. Fortunes are made over a lifetime and lost in a day. And we're not playing with monopoly money. How do you stay ahead? Who's buying? Who's selling? And why? What do they know? We want the truth. You need an edge. Boroughs and Burbs is your secret weapon, giving you the insider knowledge and strategies you need to succeed in the high-stakes world of real estate. From Palm Beach to Palm Springs, Manhattan to Malibu, we press the experts to expose the pain, find the deals, and occasionally predict the future. That's Boroughs and Burbs, Thursdays, 3 o'clock Eastern, noon Pacific. Because everyone can make money in real estate.
Welcome, everybody. Boroughs and Burbs, episode 185, Apartment Complex Investing. And we have our special guest, Dave Seymour of Legacy Alliance. Say hello.
Hey, gentlemen, how are you? Pleasure. Thanks for having me on. That's a great intro, by the way. Running through the city in the suit, then swimming with the pink flamingo. I mean, I want to watch an episode. I'm in.
We try and pump up the crowd, before with the opening
jam.
act.
So
and
good. Great.
That's
Good
our
stuff.
all right. So let me hit a few bits of housekeeping. Boroughsandburbs.com. That's where you'll find us. Roberto, is this your monthly newsletter at robertocabrera.com?
It is. It's the old one. I don't know why it shows up like that. Because
what would I learn if I went to the new one that came out this week?
What would you learn? A lot.
Yeah. All right, I'll go there. robertocabrera.com. Is it now seize the moment, or have I missed the moment?
You can seize the moment.
Okay, I can still seize the moment.
The moment is for another 18 months.
I'm John Engel. You'll find me at theengelteam.com. And Dave Seymour, you'll find him all over the place, really, but you'll find his investment arm at freedomventure.com. And you'll also find him on Flipping Boston for 4 seasons. He was on Flipping Boston, found on the A&E channel in Boston on Flipping Houses.
And Dave, is that where you are, Boston?
Yeah, just north of Boston.
Okay.
Roberto, yeah. Danvers, Massachusetts, just north, about 15, 20 minutes. So still got the Boston twang when I get going. Still there.
And one more thing, Grace Farms. I want to thank our sponsor. I went to the Grace Farms event this past week. I talked to Adam, who runs the Grace Farms teas and coffees, Grace Farms food, and he talked to me, and it's fascinating, about their relationship with J.P. Morgan. You should look for it. You're going to find, Roberto, in New York City, in the J.P. Morgan headquarters, going up right now on Park Avenue, you're going to see a kiosk with Grace Farms foods in it. Wow. So look for it. I think that's pretty outstanding, pretty, world beating when you can get into the J.P. Morgan headquarters with Grace Farms foods. Good. That's pretty cool.
Yeah.
All right.
My wife, I was looking at some of that product line there. My wife's a buyer already. Green tea, chamomile. Happy
awesome.
Place.
I'm a coffee guy. My wife, she's a tea, gal, and yet we still get along.
Yeah, still get along.
So, Dave, you've built a successful career in apartment complex investing. What initially drew you to this sector of the business?
Yeah, no, look, multifamily apartment houses, whether they're in New York City, as I'm sure you could testify, or whether they're in the Florida market where we invest, they do truly offer a passive income component if done correctly. There's a lot of noise in the marketplace when it comes to multifamily investing, from the slum landlord thought process and the famous line about the 3 T's: tenants, toilets, and trash. Right? Who wants to be a landlord? Like you've heard these stories of horror over and over and over again, and if you institutionalize multifamily investing and you bring that kind of mindset to the investment, then it becomes pretty exciting. A good GP or an operator like our own firm identifies that asset, knows how to maximize the net operating income on that asset, therefore maximizing its value in the market depending on the trading cap rates. And you start looking at the data sets for these things, it can't, it becomes real nice real quick. It's not crypto, it's not sexy investments, it's not the up and down volatility of the stock market. It's I call it the Clydesdale of investing. Slow and steady, nice and consistent, good tenant base, good cash flow, good repairs, good management. And the passive investor, the LP, the limited partner, comes in and they have an expectation of doubling their money every 3 to 5 years if the deal runs as it's pro forma to do. And that's where the magic comes in. So look, if we really look at statistics, and I'm sure you guys can testify to this also, the market is pretty bizarre right now in the single family space. I'm the father of a 30-year-old son who has a really great income and a good living and still cannot afford a single family home. So tenants by choice, and rather than tenants by financial need, separate quite dramatically. And the tenant base is increasing, its income base is increasing, and the demand is still really, really high. So, you start
How long
looking at
have you
those.
been doing this? How long have you been doing
So I've in the real estate game itself, 15 years. Along the way, it's funny, I talk about tenants, toilets, and trash. Like I carry my own scars and stories because I learned the business from the ground up. So, multifamily investing from the first duplex I ever bought, probably 12 years ago, up until today.
I would
And
think
today,
that the market's tremendously different in 12 years because there's been a lot of talk about institutions like BlackRock, big,
yeah.
huge institutions buying up apartment complexes as fast as they can, and that
Hmm.
contributing in somewhat and maybe not contributing to the run up in prices. So
Hmm.
we've all heard about house flippers. I mean, you've been on those TV shows
Sure,
and it's
sure.
been the great get rich quick scheme,
Yeah,
for most of our lives. Like, hey, all you need to do is get into real estate and flip some homes and you too could make your first $1 million. And it seems
sure.
to have moved over that sexiness that like, hey, you too can make money in your spare time to apartment complex investing.
Yeah,
And then
yeah.
we see JP Morgan and BlackRock and everybody else getting into it. It's changing.
Yeah, look, the big boys are looking for Delta. They've got some responsibilities. They've got shareholders who want to see return profiles.
So how
And
does a
if they
little guy like you or me get into the business against those big guys?
see, look, I can find, and I'm going to use some phraseology that we use in our own business, right? Some phrases, semi-institutional investments. So BlackRock isn't interested in a 75 or a 50 unit distressed asset with a mom and pop owner who's got really bad bookkeeping, has kept the same tenant base at the same income rate, at the same rental rate for the past 5 years, because Earl says that's the easiest way to do it. BlackRock's not interested in that. But when we identify an asset like that, we can go in there, we can give them a decent price for the valuation as it stands, and then reposition an asset. So
But
if I can
they're
do,
not interested in it because of the size, the scale of
yeah,
it, or because of
yeah.
what it needs.
Yeah, it's a combination. They'll take down a 500 or 1,000 unit portfolio that's a repositioning, but they need that many units for the economies of scale for them to make sense. Whereas I can go in there. uh, I'll give you a perfect example. COVID hit. We all thought it was going to be, raining opportunities in the multifamily arena due to the policies that came down, and you didn't have to pay your rents, and we had moratoriums and all kinds of crazy going on, and we're all licking our lips in the wings, going, "This is it, baby," showtime. And then certain administrations made some certain rules and regulations, and that we saw that massive influx of capital into the marketplace. And what happened was the institutional buyers, the insurance companies, and the big boys, they were coming in and they were looking at the 200, the 150 to 200 unit assets. And I'll give you an example. We were looking at one down in Miami. We're walking the property. We're about to put an LOI together on it. And as we were walking this asset, one of the insurance guys was there, and we're like, well, what's your whisper price? and they were compressing down to 2.5, 3 cap on a buy side in a market that was trading at a 5 cap, for example. So when they're coming in with that much buying power and that much muscle, a guy like me in the middle market, I got to set some really good marketing strategies in place. I got to pull on those broker relationships in the market that have been built over decades and say, where are these pockets? Where are these? Because there's always a deal to be found. It's just a case of, how many deals do you go through to buy one to execute on one, and we're probably looking at anywhere between 75 and 100 deals to do one or two. So there's a lot of work that's going in, and the institutional guys, they've got armies of people that are looking through this deal flow, but they're not fishing in the same ponds as us. That's my point. Kind of long-winded, but we fish in a different pond compared to those guys. I'm not shopping on Crexy. I'm not shopping on LoopNet. I'm not shopping with the biggest broker in the market. I'm not their guy. I'm not their
right, I
huckleberry.
got
Are
so
there
many
are there
questions
are there
here.
that many opportunities though? You're talking about seeing 175.
Yeah,
And where do they come from? Because
Yeah.
it occurs to me, if I'm watching this show and
yeah,
and I know of a mom and pop
yeah.
opportunity with bad
Mm,
bookkeeping that
mm,
wants to exit, I should
mm,
call you with
mm.
this opportunity, right?
Well, that's what Legacy Alliance is about. We've built Legacy Alliance over the past 18 months with a marketing team that I've known for 15 years. And what we decided to do is everybody thinks capital is the challenge in a real estate transaction. And I think we all know that if you find a good deal, there's always money that wants to go to work on it, right? So for us at Legacy Alliance, and you kind of teed it up perfectly, John, is the fact that if I train you in what it is that I want to buy as a company, and I put you in a position where you can deal source, deal flow, we can execute, underwrite, let's tick the boxes together so that you learn along the way. Now, if you want to go do that deal and we say it's a deal that we would do, great, you go do it. But if you want to bring that deal home, if you want to partner on it, JV on it, if you want to, a preferred return position in that deal because you found the deal, then we can negotiate those things. So, yeah, you can call us. You could go to YouTube University, I guess, right? Like many people do in this day and age. They go to YouTube University and they think they get a qualified education there, and they make offers. They may succeed. They may make some pretty serious mistakes as well. But the opportunities are always there. I'm not the guy who says, "Not forget it. There's nothing to do. There's no work to be done."
What are
I
the
think there's always
opportunities?
opportunity.
What are the opportunities that you're looking for? Like, for example, you do have some experience with flipping, but are you
Yeah.
now holding?
Yeah, so primarily for us, we're in Southwest Florida market, and we're in that market, Roberto, because the data supports it. Supply and demand, basic economics, increase in population. Florida is still the number one destination for our retirees. Every retiree brings 4 service positions to support it, whether it's in the restaurant world or the medical field. So we've got this growth that continues in the market. It also supports us as entrepreneurs and business owners and real estate guys because we're not fighting with the agencies down there, right? They're in alliance with us. Without politics aside, your red and blue states are what they are. So when we go into that marketplace and we start looking at that, the opportunities that we look for are, as I described, a mom and pop. Maybe a mismanaged asset, maybe an asset that's had some tenant challenges. We look at those and we say, can we base them on their T12, on their past 12 months rent and expenses, and what can we determine we would do as an operator to that asset to increase its net operating income? And we'll underwrite those, man. And those are coming through broker relationships. My business partner, Walter Novicki's been down in that market for about 30 years. So after 30 years, I always describe it, and I'm sure it's the same in any market. There's that one diner somewhere, right? And there's probably 4 or 5 individuals that meet there once or twice a week. And Vinny knows Joey, knows Paulie, knows Peter, or Jose knows, this guy, that guy. Like they know what's going on. That's the market where the conversations are. So we're blessed in the sense that Walter's in there. He's in that group. So we
How did
get,
you connect with Walter?
I met Walter in the real estate education space. You know, my story is I don't come from Yale, but I don't come from jail either. You know, I'm a working class guy. I spent 16 years as a firefighter and a paramedic working in the city of Lynn, Mass, working construction on my days off. So, you know, I've done this thing from the ground up. When I talk about tenants, toilets, and trash and
Why is it
construction,
always ex-firefighters own the apartment complexes? I don't, they must sit around going through the want ads in
you
between
know, it's
shifts or something,
it.
finding
I actually did a
opportunity.
That's great. I did a podcast yesterday with an ex-Baltimore fire department guy. Good guy, you know, just crusty, like crusty guy. I think his we'll go down this road seeing as a door opened. I think there's an element that I find parallels real estate investing, okay? And I think the parallels are this is that when I went to work as a firefighter, there were obviously certain evolutions that needed to be made prior to entry of a structure on fire. There were evolutions and things that needed to be accomplished prior to throwing a medic bag over your shoulder, going in and finding the right drug to give grandpa before he circles the drain and goes upstairs, right? So those evolutions were repetition, they were practice, they were education, they were commitment, they were deployment. It was every day there was something that was leading towards a goal. And then when the actual job itself would arrive, engine one, ladder one, medic one, report a smoke showing 1027 Main Street. Engine one, take the hydrant. Ladder one, take the delta side of the building. C4 come in, you're going to take control. Like those repetitive directions and systems is how a firefighter lives his or her life. Well, when you take that and you then put it into the world of real estate, if I can't look to my left and I got a kick-ass GC standing right next to me who says, I'll work these numbers as hard as I can for you. I'm committed to this job as you are. If I can't look to my other side, to my financial partners and say, you got to pony up. Here's the deal. Here's the exposure. Here's the
With
potential
a sense
upside
of urgency, with a
with a
sense of
sense of
urgency that I do not
urgency.
see from many homeowners who are
Yeah,
selling or even
yeah,
buyers until they
yeah,
lose a few.
yeah,
Buyers in the market need a sense of urgency. Sellers also need a sense of urgency, and neither one translates to the competitive world of deal flow and
yeah,
analysis and decision
yeah.
making.
But
Yeah.
so Dave, applying that
Yeah,
approach, you
yeah,
see a project. What are your first 5 tests? What are the first handful of things you're looking for?
yeah.
Start with cap
Motivation.
rate. Start with cap rate, please.
Capitalization rate. Look, the cap rate is such an interesting number, right? In the single family business, we can do square feet, beds, baths, quality, neighborhood, zip code, schools, all of that BS. But with a cash flowing asset, it's determined on the more money it brings in, the more valuable it is. Therefore, what can it trade at in a marketplace? So a capitalization rate in simplicity is an expected return on investment for the capital deployed into that deal. That's the simplest way to look at it. So when I said cap rates were crushing down to 2.5 and 3 during COVID, when we expected them to be 6.5, 7, 8, what I'm saying is we expected the market to trade at a 7% return, but the market said, kiss my ass, we're trading at a 3.5%, right? Because of the influx of money into the marketplace. So the 5 things we look at today is what's the trading cap rate in the market. So right now we're probably around 5.5, 6 in Southwest Florida, depending on deal specifics. So if that's the trading cap rate, then I got to buy better than that or be in a position to reposition the asset to know that I can make a spread for my investors at the time of exit. So I want to see what the cap rate is and what it's trading at. I want to see what the vacancy rates look like on this asset. Because if it's 70% occupied, for me, I'm buying 30% of free real estate because that other 30% isn't producing any income to me. So it can't go on the T12 and it can't go on the net operating income, no matter what the broker does with the numbers to tell me what it could be, right? I buy as is. I buy on today's numbers because my job as an investor is to then work that asset to create the valuation, to pay the LPs and put profits into the company. So what's the motivation of that seller? Why do they want to sell? Are they in the market just for top dollar? One would say everybody who's selling wants top dollar, but there are motivations behind there which kind of tie back to the single family business of, maybe it's a family owned business that's got some contention in there. Maybe it's an illness, maybe it's a divorce, whatever it is that's going. Maybe it's a business partner who decided to reallocate some assets. Ask me how I know that one, right? So there's stuff going on. What's the story? I mean, we all like a good story in real estate. So when we start looking at those things, we can begin to build a picture of whether it's worth us investigating, putting in time, putting in the underwriting, and start moving from there. So, there's a number of
And you
different
can do
factors.
all that before even seeing the asset.
Absolutely, you can. Yeah, absolutely, you can. As long as the seller gives me good data. As long as the seller gives me good data, truthful data, as long as the seller is somebody that you to do business with. I mean, we've all met some crackpots in our careers.
How often are you getting bad information?
I would say 50% of the time.
50.
Yeah, man. Yeah. Yeah. See, and this is what's interesting again. It's the difference between the institutional environment and the world that I live in, right? The world that I live in draws in the unprepared, I guess is the best way to describe it. They're not professionals.
Mm-hmm.
So do you know how to deal with an amateur? BlackRock is not going to spend the amount of time that we spend. I'm sorry. Oh, really? Oh, right. They're not going to do that. They're not going to feel the situation.
They don't have a department that does that? They send over a group, the emotional department.
The emotional support arm of BlackRock Investment. I don't think they got that. Larry never put that in his pro forma. So, it's different. I am not in the business to aspire to be, a BlackRock. Part of what we've said at the company level is, we want to be big enough to find institutional quality deals, but small enough to still stay on a personable level with buyers and sellers. Yes, go ahead, young man. You're up.
All right, I want Scott Hobbs to unmute his mic. I want to introduce you to Scott Hobbs, good friend of mine, regular on the show, and he runs the Housing Authority in New Canaan. And recently, the town of New Canaan, where I am, said, we have a housing need and we need to acquire, and this housing development across town has come on the market. Scott, go buy it. And he did. I want him to tell you this case study. I want to talk about it as a case study for cap rates and but one of the things I want him to talk about was how many bids came in. How big was it? How big is the complex? How many bids came in? How close were those bids? And who won and why? Go ahead, Scott.
Well, first, very nice to meet you, Dave.
You too, Scott.
So it was a unique situation where a property owner was getting out of the state. And so they had just recently, they were in the process of selling a development in a neighboring town that was very comparable. They got in 20 bids, ranging from a 5 to a 5.5 cap, depending on, as with everything in real estate, what does it cost? It depends on how you figure it. So
that's right.
We'll call it a 5 to 5.5 cap. And what was good for this deal for us was the fact that we asked to go ahead and sort of jump the line and if they'd sell to the town. And because there was an exact comp right there, and the buyer of that property was, let's call it a 5.25 cap, that set the price for ours. So it was 5 point, and by the way, they offered to go ahead and purchase this property at 5.25 also, and the seller actually gave us a priority on it. And then we were able to go ahead and get certain financing that was preferred, but we had to jump through so many hoops. It was.
But you also went to local investors. It wasn't just the town wrote a check. You went to investors and you said, I have this opportunity. You could buy 100-unit complex and it's cash flowing positively and it's a good idea. Are you in? What was the response?
So, I mean, that's not quite fair to call under true investors. So we actually offered up a triple tax-free 6 return. And we ended up getting commitments for around 18 million bucks in order to put into the deal. That was actually much more of a, it was attractive enough to investors that they were interested on it, but it was actually more philanthropic under the thought of allowing the town to go ahead and grab affordable housing assets that allow us to control our destiny as the state tries to force us to do other things. But that around that 6 to 7% rate at triple tax free was of interest to guys. Too much below that, the rates would have had to be, or sorry, if it was not philanthropic-ish, it would have had to be much higher. And that was even a triple tax free. Admittedly, they were subordinate debt, not the principal financers.
Are you seeing you're competing, Dave, with 20 other bidders in South Florida for that 100-unit complex?
No. And again, it's because of where I'm fishing.
Okay.
It's because of where I'm fishing. Okay. The imagery that I gave of the 5 or 6 guys having breakfast at the diner. I don't think any one of us on this call or anybody listening who has experience in this business can say that's not true. From whether it was the single family stuff back in the day to where we are today. My partner Walter always says, the best deals are done on the diner and on the turn, right? On the turn of the ninth hole. That's where they're done. Until the rules change, that's where we need to be to find those those assets that we'll underwrite and put an LOI on. I don't want it to sound like it's easy, because it isn't. We wouldn't have created Legacy Alliance and the ability to partner with as many people who are educated in the space if it was easy for us to find the deal flow to pull the trigger on. But listening to you, Scott, why wouldn't I want to partner with the city or the town, right? The government money is always preferred, shall we say? Maybe not so much today, depending on where you're at. There's some challenges. I've seen some of the capital supply get reappropriated. Not for us personally, but I've heard stories of folks I know in the business. 1 minute they're going down one road and suddenly there's a change in capital supply. But to be in that arena is always good. But again, look, for the investor, the passive investor, they just want to sit in a position like you said, 3 years tax free. The tax credit world is a great world. I'm very, very underversed and uneducated around it. I've got partners who know the tax credit world, low income housing tax credits, et cetera, et cetera. There's so many ways to bake, the multifamily cake. But the investors are pretty much always in a position where, the money's in the dirt, the money's in the sticks and bricks. It's in the assets. So even if it underperforms, it's still somewhat protected. Yeah, something can blow the whole building away, or something can happen that, you come across an exposure. But 90% of the time, it's such a strong, safer environment for capital to work. Again, full circle, especially in the unprecedented times that we face right now. Nobody knows what's going to happen next.
What cap rates, what have they been doing lately? Only asking because 10-year treasuries are now paying in the 4s. And
Yeah.
I know, so, and I got to think that's got to be affecting your world.
It is.
I mean, if I can get safe money with the U.S. government at 4.5, I want 7.5 from you if you're fishing in parts of Florida that are not obvious to BlackRock and institutional investors.
Yeah, great point. Look, finances is an education all in of itself, right? I confess quite clearly to everybody who ever listens to me, I'm not a finance major. I'm not an economics major. I'm a simple guy, but I understand value, right? I understand how to create some value. I know that if I put a nice kitchen in a single family home, mama's going to walk in the door and go, "Oh my God, Bob, I want to buy this house." And they're going to overpay for it. All right. I know that. So how do I create that in an environment where, as you say, I can stick it in a bond for a 4% return, or what else is out there? What we tend to do is educate our investors. Again, Legacy Alliance puts us in that position where, somebody says, I can leave it in a savings account or I can put it in this at 4%. And then I just give them a quick education on inflation. And I say to them, okay, why don't we talk about the inflationary environment, the reality of it, not what the Fed gives us, but the reality of the inflationary environment. And if we can come to an agreement that inflation is probably ticking around 5,
Wait a
6,
minute,
who
wait a
knows?
minute. You're buying this tired asset in Florida and you're going to your investors and you're saying, it's going to pay a 6 cap. And they're like, that's not good enough in this environment. I need a higher return. And then you say, and I'm going to fix it up. And then you go to the contractors and you find that the renovation costs for that
Yeah,
kitchen that's going to
yeah,
make the wife,
yeah,
want
yeah,
it,
yeah,
are a lot higher than you thought. So
yeah.
your renovation costs are up. Your cost of capital is way up. You're getting squeezed. Sounds like a bad time for me to be getting into this market, Dave. I'm not.
Then, it,
You haven't
then this is
convinced me
that
yet.
then this isn't for you, John.
Oh,
So going
Hold
back,
on,
are
hold on,
you?
hold on, hold on, hold on, hold on,
you're
hold
not
on.
letting me off the hook that
No, no.
easy.
See, I love that. I love that. So there's a couple of things. First of all, that takeaway in that sense, you ended the sentence with "You haven't convinced me yet." You know what, John? I'm not. Hold on. I'm not in the convince anybody business. Here's what I can do for you, though, John. I can show you that a 4%, in some kind of savings environment, could very well be good for you and your family and your financial future. And if it is, God bless you. Good luck. Good luck. I hope it works out for you. Or what I could show you is with an AIA contract, which is a fixed contract with a GC, and I've already done the work and run the numbers. Barring anything that's absurd out of the ordinary, my costs are pretty much fixed on the construction side. I know what it costs to manage an asset, usually 10% of collected rents. I know what it costs to reposition it. I know what my downtime looks like for each and every unit as I get it leased back up again. So my exit cap rate might be a 6, but what we haven't talked about, John, is the cash flow that we've generated along our 4 to 5, 7 year hold period. And then also on that exit at a 6 cap, if we bought at whatever cap rate we buy at on the front end, but we increase the valuation through net operating income over time, that's what really builds in the valuation for us and our investors. So they might be picking up 6, 7, 8%, we'll say return on their money in cash flow, but then they participate on the equity distribution at time of refinance or sale. And that's where they say, like I said, on average, you got 100 grand going in maybe, and our investors have an expectation of coming out with their 100 grand that they put in, and then maybe another 90 or another 100 for a 2x 2 equity multiple on there. And it's documented through how we do that kind of work. So
Dave,
it's an education too. Sorry, Roberto, I couldn't leave him alone.
no,
right
no, no,
there.
of course. But you're revolving. There's an exit on each one of these. There's nothing that you're
Yeah.
holding
Correct.
in perpetuity.
Correct. So the model is first of all a 506C Reg D model working with accredited investors. We're looking at business owners, high net worth individuals who can, watch this, can lose that money and still be okay, right? This isn't FDIC insured. This is an investment. You can lose every single dime that you put into it. But they then look at us and they say, well, can you do what you say you're going to do? And you show the track record, you show that you have the capabilities. Then they make that decision of whether they want to align themselves with you. Do they want a 4 year exit? Do they want a 1 year exit? Do they just want monthly cash flow? We do a lot of construction. So if I'm doing ground up construction, you ain't seeing any cash flow for a while, right? I got to build it first. But on a new construction build, depending on when they come in on that timeline, they could be looking at a 3 equity multiple or a 4 equity multiple. But they got to understand the business first. An educated investor is always a better partner. So if I've got a 4 year exit, and then they read in my PPM or my business plan will tell them clearly, we, the operator owners, at our own discretion, we can keep the asset for another 2 years. We could sell it at 2 years early if we think we can make our projected returns and get out of this deal. So guy wrote me a check one time. He was in the t-shirt business, but not like just printing t-shirts. This guy made the uniforms for the state police, and he had contracts with government. Had a really nice business. He wrote me a six-figure check for an investment one time. And it was pertinent. I never forget it. We were at a diner and he says, I'm going to write you this check. He says, and his language was very concise. He said to me, Dave, I understand 90% of the deal, right? Like we have this conversation and I'm assuming we all know cap rates and, yield and deltas and all the language we use. And this guy said to me, he said, I understand 90% of the deal, but at the end of the day, Dave, he says, I'm betting on you, the jockey, and not the horse. And then he looked at me and he said, don't fall off the horse.
That's
I'm
great.
like, that's not my goal, Jack. It's not my goal. Because at the end of the day, I'm a steward. I'm a steward of other people's capital. People first, profit second, and that way we get to be, we get to be in business a little longer.
What have you learned the most since you started this? Like, what's changed and surprised you? And what did, for example, what are like two things that you're like, if I knew this then, or these are things I really have learned that no one, that people should know. I mean, that's incredibly difficult to do.
I get questions like that, and I have an internal filter, and I usually don't pay attention to it. I'm going to be frank with you. I don't pay attention to the filter. I'm not a politically
family show. This is a family
Yeah, I
show.
know,
Just
I
put
know,
that out.
but you know what? At the end of the day, the dollar bill, it has its own conscience. You know what I'm saying? So, you asked me what I've learned, what a couple of things that have been impactful. If you get an email from me, my email tag says a yes or a no is more valuable than a maybe. So that's one of the first things I learned. I learned to, and it's kind of sad, I learned to not trust anybody. Really, it's a horrible statement that I have to make, but it's based in pain, right? It's based in, yeah, I'm there for you, dude, and then they're not. Overfund and overcommit to the point of 66%. It's interesting. We've talked a lot about, Roberto, there's this asset class being attractive to your BlackRocks and your institutions, and then on my side, the same quality of asset being attractive to retail investors, as we call them. When the institutions get a pledge or a commitment, that's pretty much done money. That's money in the bank, right? In my world, I've got to overcommit verbally, even signed commitments. I've got to do probably 66%, because I know that only 30% of that commitment is actually going to fund and come through.
How many people into a deal? You have to find 100 investors or 20?
It depends on the raise, and it depends obviously on the size of the deal. I think that the biggest number of individual investors in one deal is probably around 35 or 40. When you've got investors who can, commit 250 up to $1 million.
And what's the timeline? You've approached those 50, you need 35, and they really have a week to decide, and then we got to move on to the next, cut.
Yeah, so that's a great point too, right? That goes back to our urgency. I, as the salesman, let's be honest, I'm selling. You sell a piece of real estate, I'm selling an investment, or an opportunity. Sorry, SEC's listening. I don't sell investments. I just share opportunities. But you got to create that sense of urgency, and that's just education, truthful education. So if I do, like we did a webinar, we're buying a retail piece in the Naples market, and it's a $7 million raise. We already had maybe 3 million of it in the door when we did our first webinar to our database, and we'll wrap that up within 10 days after that webinar. Go through a couple of commitments, a few more questions. People spending time in the data room, making sure they fully understand what it is that they're investing in. Wire funds, and then we'll close. So we'll bring that capital into the accounts probably 10 to 14 days prior to close to make sure that we're there. We don't want to be at the closing table short of, 300,000 or 3 million, whatever it is, and then close on the asset. So getting people to stay engaged is critical in the retail investor world, and that's obviously the big difference from the institutional guys.
Wow. So what other markets besides Southern Florida? And I didn't say, you didn't say Southern Florida, you said Florida. But what other markets do you find as appealing as that, or as a potential alternative?
Yeah, it's not a secret. I mean, the Sun Belt in and of itself is still a great market for us in the multifamily. We like the Carolinas. We like Texas. We like some of the Texas markets. We're not in the primary markets. I mean, we do our best business in the tertiary, secondary slash tertiary markets. And we're just picking and choosing and looking through those. For me, personally, if I don't have enough of a quality relationship with an operator in that market, I'm probably not going to put, an excessive amount of effort into that. Because of the TV show, because of my years, on stages and teaching and traveling, et cetera, et cetera, I've been a blessed guy in the sense of I can go into a lot of different markets in the US and oh, Dave, yeah, I remember we met, right? And I can pick up where I left off. If I get some deal flow in San Antonio, there's three guys I can call in San Antonio, just say, hey, Paul, will you go take a peek at this, take a peekaboo. It's a 75 unit, blah, 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 blah. And he'll either say, yeah, no, I know that asset, or no, I didn't know that asset. Yeah. And then, hey, you want to partner on it? So, we can open up those lines of communication as well. So
What do you
that's
say
a
to those
benefit for us.
people who say that Florida's been picked over? All the good deals are gone. Same with the Carolinas, same with Texas.
Oh,
Those
I
are the
tell
three of
him,
the boom towns for the last 10 years. And
yeah, I tell him
we're
yes,
starting to
you're
see
right.
Austin suffer, right?
I tell him,
Austin
yeah,
prices are going down. A lot of people are saying, show
yes,
me the next opportunity, Dave.
yeah, you're absolutely right. All those
Memphis? How are we
all those
liking
markets are
Nashville?
picked over. It's not for you, John. It's okay.
How are we liking Memphis and Nashville? I've been hearing a lot of good stuff about Tennessee.
I heard there's some potential there. Who knows? Let me call
Okay,
my guy.
okay. You're still a fan of Florida, huh? Because we
No,
did
I
a
am.
show last week where the
Yeah,
price per foot on the three new developments that was $1,500 a foot, and we got the sense that everybody's focused on South Florida right now. Brickell, Lauderdale, Boca to Palm Beach, and
yeah,
then and that the traffic is crazy. The prices have gone through the roof.
yeah,
It's
yeah. Yes, absolutely right.
and you're still
Yes,
finding deals.
yes,
So the deals, but
yes.
at least there's a lot of deals that are coming to you. You're like kind of getting a
Yeah,
first look in some ways. Is that
yes,
because of
yes.
what happened with the show and the people, you're a known
Yes,
entity?
yes, it's reputation and it's known entity, right? The broker is going to go to their top five, right? They don't, you guys know the game. Everybody talks turkey.
Yeah.
Who's going to write the check? The broker only gets paid at the closing table. The investors only make money after the deal's closed. Let's weed through all of the conversations and really get down and dirty. So, the deals that people say they're going to do that they can't do, they come around to us. We get first look at a lot of stuff as well. We are expanding into some of the northern markets of Florida, up to the Panhandle, up the top side. Um, I've got guys reaching out to me or doing co-GP funds now, and they're looking at some opportunities in the Carolinas still. Yes, I like Memphis. I got a guy in Memphis who's been busting my ears for about 6 months now. We see that whole Memphis vibe is beginning to get some traction. I try not to get sucked into the sexiness of a market. We all know that an emotional buy is a bad buy, right? We know that. So if I can find a data set inside a market that really makes sense for us, then I get excited, right? There's nothing
Is
more
the
exciting than,
sexiness kind of like what happened to Austin?
yeah. I mean, you've got this imagery. Vegas had it back in, the early 2000s. We see this regentrification of these areas over and over and over again. I'll use Boston
But is
for an
that an
example.
opportunity to get in and get out quickly?
It is to some extent. To some extent, yeah. Look, in and out quickly for me, Roberto, is always 4 units and below, right? I want a buyer. I want to get out. I want to make my money and move on. The bigger buys, the development work, the multifamilies, there is, for me, there may be some guys who do, but for me, that's not an in and out, right? It's a 3 to 5 year hold is what I prefer to look at.
Let's talk about New York market because a lot of our viewers are into the New York market. Roberto's been talking to us and give us some detail, Roberto, but rents in Manhattan are at record levels and have been for the last year or so. Not so the price of a condo in Manhattan. And so when you evaluate a market like that, if that were true in Florida or in Memphis, you'd say, okay, these are you looking at these rents can continue? Or are you saying, oh, this is an opportunity where rents are high and for sale is low? This is a good opportunity. Roberto's been saying that for the past year. We're at a low point on the 10-year cycle to buy, a one-bedroom apartment in New York. It's
We're
as cheap as
flat.
it's ever
We're
going to be.
flat. We're flat.
We're flat.
Flat.
We've been flat. So is that
Pricey
what
is
you're
still
looking at in
expensive.
Florida, or are you starting to see an inversion of those two things?
It's flat in Florida. I'm gonna
Rents or for sale? What's flat?
for sale, it's still low inventory, high prices,
Okay.
right? Rents have stabilized.
Okay.
Rents have stabilized. 3 years ago, we were pricing out maybe three bed, 2 bath, 1,000 square feet. Depending on the market or the specifics or the quality of the asset, it was anywhere between 18 to 2,500. You got to remember, I'm not in the high end market. I'm in the workforce housing market. I want to find housing for cops and firefighters and teachers and restaurant workers. So we had that, but we've seen a stabilization in that. It's probably stabilized around 2,000 now for that same rental income. But still, the cost of an home ownership and the cost of capital for home ownership is out of reach for so many. Look, man, I would suggest, and I'm okay to be wrong, New York is an anomaly in and of itself. It's kind of a special place. You know what I'm saying? You can't, like, I wouldn't invest in New York. I wouldn't spend the
Why?
time to, I wouldn't
Why?
spend I don't need to. I don't need to. I don't want to work that hard. I'm doing okay. So, if I was starting from ground zero, all over again, I mean, if you think about it, you think about the burbs of New York, right? 1970 to 1985, 86, 87. Nobody wanted to be there. It was bad, man. And we go through that regentrification and influx of yuppies and all of that stuff. It's in every market that you begin to see that. We saw it in Boston, in South Boston, East Boston, Chelsea, Massachusetts. Chelsea was known as the armpit of Massachusetts. Now you go into Chelsea and it's 2.7 to $3 million for a 3-family property that's converted into condos that could sell for 2 million on their own, right? So you see these changes over time. What is that doing? That's driving home ownership away from the average middle class American. It's so hard. So where are they going? Well, they gotta get something decent, clean, and affordable. So my point is, you've got a macro market, right? And I would say, the 5 boroughs of New York is a macro market. Well, in that macro are micro pockets. And that's where the money, I feel, is made, John, whether it's in New York or in Southwest Florida, or whether it's in Memphis or Austin or Dallas or wherever it is. You've got these micro pockets within these macro environments. And if you can dig your way in there and find these diamonds in the rough, for want of a better term, that's where we see the opportunity. I'm not going to argue the data set of the average rents. I'm not going to argue the data set of supply and demand. But if I can use some common sense and go in there and say, okay, there's not enough here to support what's going on here. How quickly can I build it, or how quickly can I buy it? And if I can build or buy it quick enough to support the need in that market, then I'm going to execute. I'm going to do my very best to raise the capital and get the project done.
what I hear you saying is that you can find opportunities in New York or Florida as long as you really know your market and
There
you
you
really
go.
know your
There it is.
market and you can
Numero
find
uno.
diamonds.
Yeah,
And
yeah.
Roberto really knows New York and the difference between two buildings across the street from each other.
Hmm.
So
Hmm.
you
You know what's
can,
interesting is, with the single family business. So I raise the money up here in the Boston market and deploy that capital with my partners in Southwest Florida. But I know the Boston market, man. I know it from, Falmouth on the South Coast up to the New Hampshire line. And even today, a wholesaler will give me a quick buzz on a single family home. And within, 45 seconds to a minute, I can look at 10 pictures, look at a market, quickly pull a comp set from MLS, and I'm like, I'll do that deal. Do you need me to close tomorrow? What do you want to do? You want a little taste? You want to check? You want to stay in it? You want me to do it? What do you want to do? Like that, and that's repetition. Goes back to the firefighter concept. Those are the evolutions. Well, number one rule is know your market and learn how to sign a check. That's what my ex-partner used to say. Know your market and know how to sign your name. And if you can do those two things, you can make money in real estate.
because
But
you talked about the five things up front, cap rates and vacancy rates and all that,
yeah,
but it's all predicated on the fact that you know that market
yes,
first.
yes. Those are the components that support, your philosophies in single, multi. I don't care what it is. We're looking at light industrial right now. You talk about the rents stabilizing in residential. I'm on this show as a multifamily investor. I really should be on this show as a real estate investor in the commercial arena because I'm taking down a retail piece. I'm in the middle of finalizing my numbers on a piece of dirt that we own where we're going to put in, I think we're up to 16 light industrial units. They call it flex space in Florida. And flex is beautiful. I mean, I'm getting all excited about this stuff. Flex is designed to, perfect example. Here's a 2,000 square foot condo in flex space. And what we can do is we put the kitchen cabinet showroom in the front, and the guys are building the cabinets in the back. It could be a restaurant. It could be an accountant's office. So it's not technically just a retail space. It's a flex space.
We
So
need to
you
bring
got
you back
all,
for that. That's a whole show.
that's a different show altogether. Yeah, yeah, yeah. But it's cool, man. There's some great stuff if your ears
Dave,
are open.
what in this space, of multifamily investment, what keeps you up at night regarding your portfolio? Like, what are you concerned about over the next year, 2 years? Like, what's
Like insurance companies dropping you for
yeah, all that kind of.
all your properties,
Yeah,
maybe.
yeah, yeah. Insurance. Look, man, we got the insurance challenge. We got the hurricane challenges. Mother Nature beats the crap out of Florida every year. Looks like she's going to continue to do so. So we've had to get creative on the insurance side. I'm just going to give it to you high level because I'm not in the weeds on it. My team is. But we're beginning to find some insurers will split the exposure on one asset. So instead of just one insurer on one asset, you might have two or three insurers on one asset because we're going to build them. We have to insure them. We have to underwrite them. So we see some creativity there. Look,
So, and they know about that themselves. They're hedging each other.
oh yeah, oh yeah, they're coming in together. Yeah, yeah. It's especially after the past few hurricane runs that came through there. I'm in Fort Myers and Cape Coral, and we've taken a beating. We've just taken a beating in the past few years down there. But yeah, that keeps me up at night. What really keeps me up at night is property management. They'll make or break my deal. Are you using a good management team? Do you have good relationships with them? Are their systems integrated with yours? I it's funny today. I watched the bank accounts, man. I watch money in, money out. Again, because not only is it company accounts, but John and Roberto and Scott all wrote me a check for 500 grand a piece, and I told them I was going to double their money in 3 to 5 years. Well, I better pay attention, right? I better pay attention. So, expenses, change orders, all of the day-to-day operation. But if I know how to get in and out of a burning structure and be blessed enough to bring somebody out with me, this is just sticks and bricks, brother. This is just real estate. This ain't nothing. This
That
ain't
management,
nothing.
though, debt management, do you third party that out to a
We do.
partner, or do you do
We
that?
do. Third party. We're not vertically integrated. We've looked at it. We run a lean ship, right? So we can systematize control and oversight of property management, construction, the pieces of the puzzle that you need to put together. We can do that from our side of the equation without bringing on the additional employees and companies, et cetera, to do it. So up until this point, that's what we've chosen to do. Does that mean we wouldn't go vertical on some of that stuff later on? Maybe, right? It's economics again. Do the numbers make sense? And if the numbers make sense, then we'll do that.
Wow.
This has been a great show.
It's amazing.
Yes, it has.
Yes. I think, I think this is really interesting because a lot of people think, okay, I want to do house flipping. But it'd be so much better if I could buy a multifamily, and how do I get started? And I think the things I've learned in the past hour is, number one, you really have to know your market. I can't start with, oh, look at that, a 7 cap. Ooh, a 9 cap in Memphis. If I don't know Memphis, there's a reason. So I got to start with a market I understand, or have a partner like you who knows that market inside and out. And I think it starts there. The second thing is understanding the cap rate, the vacancy rates, the story, the motivation of the sellers. And then this last piece where you said, well, what keeps you up at night is the management. I mean, these things don't manage themselves.
Right.
And so it's not enough to say, I know the market and I bought well. And I thought I had the right management team in there, or I did, but the circumstances changed. And it became too much for my management company to adjust. Lot of pitfalls. And so I can see why, in that last question, what keeps you up at night? If it was easy, mom and pop wouldn't be selling. Right?
Correct.
If there were no
Correct.
hurricanes
Correct.
and insurance companies all said fine, then mom and pop wouldn't be selling. But some of that pain is why there's opportunities for you in the market.
Early in my career, I purchased a 9-unit in the south side of Chicago. It was a South Jeffrey. It's a nine-unit property. One could argue that it wasn't the best part of Chicago. I'm just going to say
What could
that.
possibly go wrong? But it was a 9 cap, guys.
It was better than that. It was a 15 on the buy, and it was right after the crash or the adjustment. And we're walking this property, me and my partner, with the property manager. Big dude. I mean, I'm 6'3", 220. This guy made me feel like I was 5'2", 180. Right? He was a big dude, and I've got the concern. I'm in Boston and I want to buy a nine-unit property in the south side of Chicago. And I just looked at the guy and I said to him, what is your system? And this is a true story. What is your system for collecting rent? I said, do you have any challenges? He just opened up the inside of his jacket and showed me something that he had in there. And he said to me, he goes, what did he call me? Mr. David. He goes, Mr. David. He said, I've never had a problem collecting the rent. He said, and we won't have a problem collecting rent for you. And I made an offer on this property. The bank denied it. It went to short sale, and I ended up buying it for less money than I had offered on it, 6 months earlier.
Did you keep him?
Oh, of course. Of course. I invited him up to Boston. We sat down, we ate dinner. He became a member of the family.
Does it have a
He
happy
stayed on.
ending?
It did. It did have
Okay.
a happy ending. We went in for a tax abatement. We got a beautiful chunk of change back from the city of Chicago. We held on to that for about 3.5, 4 years. The market went crazy, even though it was South Side. You can make money. I've made money in, C/D neighborhoods. But again, to our point of our conversation, property management is a lot more intensive in the South Side of Chicago, than in Cape Coral, Florida. So, again, the guys are betting on the jockey, not the horse. And this jockey has run a few races, right? So you carry that experience. as I'm
Just
sure.
stay on, Dave. Just stay
don't
on.
don't fall off the
Stay
jockey,
on that
dude.
horse.
Don't fall off that horse, man. Yeah.
All right. This has been an awesome show. I want to
Amazing.
thank again, sharegracefarms.com, their teas and coffees. Go visit Grace Farms if you're in the neighborhood. This has been Dave Seymour of Legacy Alliance, but you can go check out his Flipping Boston TV show. And you can check out Freedom Venture if you actually want to get involved in investing with Dave. I'm John Engel. That's my friend Roberto Cabrera. We love you, Roberto.
Love you too, brother.
I love
And
your
that's
hair.
Hobbs Inc. Scott Hobbs. That's just some of the modest construction that Scott Hobbs builds. You know, you have anything like that in South Florida, Dave?
Typical
We do, but
multifamily.
we don't own it. We don't own that, Scott. You build it. I'm still not going to buy it.
You can get great discounts on these. I'm telling you.
Yeah.
And you'll find this show up on boroughsandburbs.com. So if anybody asks, hey, where do I find that show? Boroughsandburbs.com. You'll find it there in, I don't know, 15 minutes. Thank you, Dave. This has been great.
Gentlemen, God bless.
Awesome.
No, I appreciate the conversation. Thank you.
Thanks so
care.
much.
Thank you, Scott, Roberto. Till next
Scott?
week.
Good.